would count myself as a value guy, and that I was
Mhm.
learning about, the intelligent investor and Seth Klarman and margin of
Yeah.
safety before I learned about Bitcoin. What I would add would be that specifically, I think what helped me the most was creating a dichotomy in my mind of what is the market price and what's my subjective valuation of the asset. And being comfortable with the fact that in a bear market, the market price is less than my valuation, and a bull
Mhm.
market is above, but I have a multi-decade thesis, and so why would I take any action other than just adding to the position? Because even if we're short-term overvalued, long-term it's going to grow into that valuation, and you got to have some humility about it.
The opinions expressed in this podcast do not necessarily reflect the opinion of Arcos Global Advisors or its advisors. The mention of different asset types or securities do not constitute a recommendation for our clients. If you have any questions about the content of this podcast, please contact your advisor. Welcome to Navigating Bitcoin's Noise, the show where we cut through the clutter and bring you the clearest insights on Bitcoin. I'm your host, Kane McGukin, and today I'm joined by Pierre Rochard, longtime Bitcoiner and builder whose path runs from Wall Street securitization to Kraken, Riot, and now founding the Bitcoin Bond Company. In this episode, Pierre breaks down the emerging market for Bitcoin-backed notes. We discuss how private credit and declining volatility set the stage for true Bitcoin yield and what ETFs, custody choices, and KYC AML realities mean for adoption. We also dig into stablecoins like Tether and their role in dollarization abroad and how that liquidity ultimately strengthens Bitcoin's financial plumbing. If you're tired of hype and want a first principles tour of where Bitcoin finance is actually headed, this episode is for you. So sit back, relax, and let's get started. All right, thanks everybody for joining today. I have with me Pierre Rochard, one of the foremost deep thought guys in Bitcoin, has some of the best knowledge out there in Bitcoin. So today I wanted to get with Pierre and talk a little bit about BitBonds. It was big in the spring, it's still kind of growing. He's building on that front, but has taken a back seat based on all the other things going on in the space. So Pierre, thanks for joining. Maybe we can, you don't have to give a big background, but I believe you kind of spanned Wall Street to mining to now what might be on the fixed income side of Bitcoin. So maybe you can give a little light on that, on your background.
Yeah, sure. So in high school, I got really interested in Austrian economics and open source software. So I was installing Linux on computers, reading about full reserve banking versus fractional reserve banking and gold and silver and sound money. Really enjoyed Rothbard's histories of kind of monetary systems, but also kind of branched out and read more mainstream things like Michigan has a textbook on monetary economics from kind of a more neoclassical, neo-Keynesian uh, academic perspective, mainstream academia. So I was always very interested in that. And when I was kind of completing my master's degree at UT Austin, I was getting my master's in accounting. I happened to start talking with Michael Goldstein and Daniel Krawitz at the University of Texas. They had launched a reading group for Austrian economics called the Mises Circle, and they orange pilled me, right? So I was asking questions of, well, what about the cryptography? Can't you always break the cryptography? And did not know about the 21 million until they brought it up in conversation, and that's when it really clicked for me that this because I understand open source software, I can like wrap my head around the fact that nobody's going to be able to change the money supply here. Um, and that's when I realized that this is going to be better than gold and silver because 21 million and it's funny because before I even knew about Bitcoin, I had kind of the thought of, wouldn't it be nice if there was something more sound than gold, because gold expands like 2% a year or something like
Mm-hmm.
that. And obviously didn't invent Bitcoin, but had a kind of a proto Bitcoin thought there. um, so in any case, I started my career in public accounting at Deloitte. I was performing audits of new mortgage-backed security issuances, commercial mortgage-backed securities, student loan securitizations, automobile loans, cell phone towers, you name it. They had some kind of collateral on the asset side of the balance sheet, and then some set of liabilities on the other side of the balance sheet. But even back then, I had the thought, because I thought, Bitcoin's going to be the best performing asset for, especially if you look over like the next 5 years, right? Obviously, if it's like next year, yeah, Bitcoin might be down 80%. But even back then, I had the conviction that it was going to continue to grow long term. I started writing articles for the Satoshi Nakamoto Institute, blog posts essentially, explaining kind of my analysis of the intersection between monetary economics and Bitcoin. So that was like 2013, 2014. So I'd encourage people to go listen to those as kind of archaeology. But that has withstood the test of time. We actually just recorded some podcasts with Michael Goldstein, reading them in light of 10 years of experience. And it's funny what came true, what did not. But in any case, so I worked in public accounting. I worked, and at the time I thought, well, what if you put Bitcoin in as the collateral instead of these fiat loans? Because these fiat loans are yielding 6%. And so, tranching that up, isn't that less interesting than tranching up
Right.
something that is yielding 100%, right, of a Kager? Now it's fallen to maybe 40% today, but, it would have been a good time to do it back then. But, the Winklevi twins ETF was back then, and it got denied. That was the
Hmm.
first ETF filing. So, the writing was on the wall that the SEC had kind of a closed door on any kind of Bitcoin tied financial products. Um, on top of the fact that, there just wasn't institutional demand back then, it was purely retail driven. I would argue actually that if we look at the Bitcoin treasury companies, a lot of it is retail driven as well,
Yeah.
more so than institutional driven. But in any case, had a lot of different roles in the Bitcoin industry. Worked in TradFi as well, at Hudson River Trading. Worked at Kraken as a Bitcoin product manager. Got Lightning launched there. Worked at, most recently as VP of Research at Riot, where really the focus was pushing back on this ESG narrative against Bitcoin mining that was being paid for, through NGOs like um, Greenpeace, and then of course Elizabeth Warren and her bully pulpit in the Senate. Um, but obviously that was very successful. We don't even hear about Bitcoin mining energy consumption anymore.
Yeah, we don't
Um,
the whole tumble dryer argument,
yeah.
are people gonna stop drying their clothes, or is everybody gonna turn off server farms because they use more energy than Bitcoin? And, yeah, a lot of that didn't make
So
sense when you drill
yeah.
down into it.
And so in any case, fast forward to, Trump winning, and we're not worried about ESG so much anymore. And we have a new SEC. And the BlackRock ETF has been the most successful ETF launch in the history of ETF launches. Like, clearly to me, there was a confluence of factors where it makes sense to circle back to my initial idea of securitizing Bitcoin and actually follow through on it. So that's why I decided to found the Bitcoin Bond Company.
That's awesome, and I think what sticks out to me, in what you just said and the path that you kinda took, you took a little bit from every industry that you were in, but really rooted it back into the principles of Linux. And if you spend any time on Linux or messing around with Linux, it's difficult, but it's better. It's stable, and the way that Linus put it together is more built for the 21st century open source manner of things than, say, a traditional, 20th century Microsoft or even Apple. To an extent, they all have their different ways of doing it. But, you know, that kind of leading into the peer-to-peer nature with Napster and everything that came after it, and then how you sort of recognized the value of collateral assets from the CMBS time. And I think that's what's most interesting when I started seeing the Bitbond, stuff come out this past year, and then you kind of transition to set up the Bitbond or the Bitcoin company to focus on that. So, um, Where do you see kind of as it stands now? So it's very clear that obviously with the Bitcoin treasury companies, I would agree with you. When you look at the charts, they're characterized very much like crypto has in the past, but the general underlying principle of we have this new collateral asset, financial services for thousands of years is about taking a collateral asset, slicing it up, doing different things with it, creating different risk and reward off of it. Where do you see um, kind of how this playing out, or where are you kind of focusing most on in terms of using a digital collateral asset in the 21st century and how that changes markets in general?
Yeah, absolutely. So, first, I want to kind of get into the BitBond side because I think that there's kind of two different formats here. One is the BitBonds, which that term has been popularized to talk about not using Bitcoin as collateral, but actually using the sovereign grade credit of a
Correct. Yep.
like federal government, treasury issuance that adds a small amount of Bitcoin to it in order to push down kind of the interest rate, the cash interest rate that they have to pay. And so that I think is a great idea, and I think that that's going to exist eventually. What I'm focused on is really on the private side, which is that let's underwrite Bitcoin as collateral directly and not have any kind of issuer credit overlay on the collateral. So you
Hmm.
put it in a special purpose vehicle that's bankruptcy remote and that only has Bitcoin on its balance sheet. And so that's the purpose of securitization is kind of splitting out the risk return of an asset from the sponsor or from the where that came from. Um, and I think that when we look at where is this going to go, well, the main driver for both Bitcoin treasury companies and this whole ecosystem of financial instruments being built around this is that Bitcoin's growth rate is greater than the cost of capital.
Yep.
And so that's really the big picture idea. And then when you kind of draw that line of, okay, well, what does that look like when that spread converges? Either uh, society-wide cost of capital increases, right, to get to Bitcoin's CAGR, or Bitcoin's CAGR essentially has decay on it, right? Where, yeah, today, let's say it's 40%, maybe in 20 years it's 20%. Um, but in any case, that I think that these are large macro secular trends that are going to play out over several decades. And so, just like, for example, talking about Paul Volcker, in 1980
I would.
with interest rates at 20%, all the way to interest rates at 0% under, Bernanke, Yellen, or now Powell.
I,
So,
I think that's a just a pause right there. That's an important point because we've been in this 40 years of interest rate decline. And if you look at the history of money, of lending, borrowing, and just having a yield, it's just naturally how the human brain works. I have this high yield, and if the yield's not high enough, you can't really borrow and lend off of it, right? Because those lenders that are taking on risk that the borrower might not repay, they're not getting paid anything for it, and so it's a lot of risk. But that was something that's interesting. If you look at Bitcoin at the beginning, the early years, 200% volatility, then it goes to, 100, 150. It's now in the 40s, and you can see that very similar structure. But as you pointed out, we don't have the collateral set aside so that it's not encumbered by some public company or some other, person or entity, um, to create that bond market like instrument in that yield curve, or something like a CMBS. I mean, even if you look at commercial properties, so you've got developments, there's a lot of risk that goes in building those things up. You have land as the collateral, structure as the collateral. What if you threw Bitcoin on that as a small sliver, just like a bit bond, say at 10% of the initial development? Now you have three forms of insurance if that property goes belly up, which is not uncommon when you build out cities and things. So I think that's a point that's really important, is that declining vol structure is historically what has given us the ability to create financial markets off of it and risk curves off of it.
Yeah, and we're also seeing it get monetized directly. So,
Hmm.
for example, I just saw that BlackRock has a new iShares ETF for Bitcoin. That they're calling like premium income that is going to be harvesting and monetizing that volatility on Bitcoin. So I do think that it's what something that all of this financialization combined with 95% of the Bitcoin already being mined is that we're actually in a completely different market environment than we were in the past three cycles. And I
Hmm.
think that's going to cause a lot of brain damage for Bitcoiners because, we're creatures of habit. We don't like when things change. Um, but the reality is that the economics have changed at this point. And so I do think that the price is going to behave very different and has been, by
Yeah.
the way, behaving very differently than it did in the past.
Yeah. I mean, even if you look at the decaying cycles just from a power law perspective, at this point in a traditional cycle, it should be price should be a lot higher, volatility should be a lot. I mean, you've seen the charts in just the past week where volatility just fell off the table, and it comes from that monetization of vol in a public market with all the kind of ATM and all that kind of stuff. And then, as you said, you're starting to get people like with BlackRock and others and the Misties and all that kind of stuff, where you're capturing that vol on the Bitcoin side through different ways with public instruments, but we're still waiting on kind of the core fundamental instrument to be used. So I think I was excited to see somebody like yourself step out and say, "Hey, I'll go create that thing," rather than let's wait for 15 years for it to get through regulatory hurdles to bring an asset to market. I mean, eventually it will, but um, that's really important to me. Just seeing that play out, and I think uh, wherever this cycle kind of shifts to, because I agree with you there, or it ends early and people get disappointed because it's not the 4 year cycle. It will kind of flush out that retail, the grift, and you'll get back to the serious builders like yourself. I mean, I think we've seen that a number of times. So from that perspective, um, what is I mean, you're long term in nature. You've stayed around for a long time. You've always kind of been on the building front. What does, say, the next 4 or 5 years look like, and kind of your area of focus as you look to bring something like a bit bond or a true Bitcoin based fixed income like instrument to market, that can set a floor for pricing of whatever else is to come.
Yeah, absolutely. So, when I was setting out on kind of the entrepreneurial journey, what I didn't want to do was do something that's already being done. What I think is already being done is putting Bitcoin in equity wrappers. So whether it's iBit or a Bitcoin treasury company, and then putting it in a convertible note wrapper, right? So like Sailor has
Hmm.
accomplished and others have as well. Um, and then putting it into a perpetual preferred wrapper, right? Which is
Yep.
what Sailor's done. So all of those activities, I think, are extremely valuable, create a lot of value for society, and are going to grow at a pace that is just mind-boggling, and people are going to lose it. Okay, so I think that that is going to be an extremely successful approach to Bitcoin securitization writ large. Um, then, when I look at kind of the BitBonds model, or what Andrew Hans is doing with battery finance, so there, I'm also extremely bullish on it, which is combining, let's call it real world assets, with
Right.
some amount of Bitcoin to change the risk return structure for those investors. Um, and then there's also, I think, a really interesting market where it's whether it's Unchained, which does lending against Bitcoin and cold storage. I think that eventually, I I've talked with different people who are interested in doing that with a commercial bank,
Yeah.
right? So that's going to be really interesting as well. Um, and then for my purposes, I'm just looking at, okay, well, what if we have a structure that is targeting a very specific kind of buyer? And that is the buyer that cannot buy equity,
Yep.
and can't even buy fixed income preferreds, and really also can't invest in a medium sized business like Unchained, on the capital structure. And so the you know when I think about that context, you have to break some rules. So, for example, with my vision for Bitcoin backed notes, it's really that it's got a maturity, and so that maturity is far out enough to kind of get through the typical Bitcoin cycle, if that is going to exist going forward. Um, but at the end of 5 years, we're planning to sell the Bitcoin and to
Hmm.
pay off principal. And so I think that that's something where uh, existing players can't play, right? And so strategy can't do that. And the reason they can't do that, or don't want to do that more precisely, is that you have a matching between what is the duration of a public company. It's infinite, right? What's the duration of Bitcoin? It's infinite. And so then when you look at the liability structure, you want to have liabilities that don't have refinancing risk.
Right.
Um, with an SPV, you actually isolate all of that risk into a container, that then, for different risk appetites, you can
You can put
have
a
some
date on
different
it.
percentage of your portfolio in that container. And you can dollar cost average into it, right? Where we would do a new issuance at a steady cadence of quarterly or biannual or whatever it ends up being. Um, and so those kinds of buyers have been growing tremendously due to Dodd Frank, really, because after the financial crisis, all of the regulatory pressure on the commercial banking system has been in the direction of holding more reserves, being more conservative, lending out less. It's had perverse effects, like what we saw with SVB, where they blew up not because of bad loans, but because they were, in a
Basic
bad.
bond math failure.
Yeah.
Yep.
So now what we've seen is the emergence of the private credit industry, right?
Yep.
Private credit funds, where their mandate is really to replace the role of commercial banks. But I actually think they do it in a much better way, which is that they actually match up the LP capital duration with the lending duration, which commercial banks don't do. They've got demand deposits that are callable,
They
same
just
day.
rubber stamp it because they're like, this will be forever with no thought
Yeah,
about
so
time
they
frame
know they're
where
going to get bailed out.
yeah, where
Um,
private credit is actually doing true underwriting.
they are, and so that means that they, in many ways, have more flexibility and leeway into
Mhm.
what they can do because they don't have to worry about the FDIC, coming after them. What they've got to think about is, what is attractive on a risk return basis, and I think that Bitcoin, even wrapped in a vehicle like a structured note, is very attractive,
Mhm.
and so is going to appeal to different kinds of either risk off conservative investors who think, well, we want to be a part of Bitcoin, but we don't want to
Yeah.
be first loss on it
Right.
over the next 5 years, versus a more aggressive, potentially, distressed credit fund or
Mhm.
a hedge fund that wants essentially to go leverage long Bitcoin by taking the other side of that transaction. And so the premise here is that there are trapped pools of capital that have investment mandates that are credit only and that want Bitcoin exposure. They're bullish on Bitcoin. They see their friends in the equity world, doing rather well. There was a Wall Street Journal article about Capital Group, and Mike Casey there, who's like a old school Warren Buffett value investor who bought a lot of MSTR a long time ago. Uh, but sorry, in 21, right? I say a long
Yeah.
time ago. I mean, like, um,
That is a long time
and
ago in Bitcoin.
and has done extremely well for
Yeah.
that fund, which is typically a pretty conservative underwriting process, and
Well,
he had a
well, if you
thesis.
you look at Mark Yusko, even Kathy Wood, they all describe themselves. They're all deep value guys, and all the big time investors that have stayed around for decades. They're deep value guys, and once they spend time on Bitcoin, they get it. But the market, the populace, the people assume that if you just go out to a dinner party and you talk about Bitcoin, it's like, oh, you're trading, taking a lot of risk there. But it's the value guys that really get it.
Yeah, I think what so I would count myself as a value guy in that I was
Hmm.
learning about the intelligent investor and Seth Klarman and margin of
Yeah,
safety before I learned about Bitcoin.
same.
Uh, and what I would add would be that specifically, I think what helped me the most was creating a dichotomy in my mind of what is the market price and what's my subjective valuation of the asset,
Correct.
and being comfortable with the fact that in a bear market, the market price is less than my valuation. In a bull
Hmm.
market, it's above, but I have a multi-decade thesis. And so why would I take any action other than just adding to the position? Because even if we're short-term overvalued, long-term, it's going to grow into that valuation. And you got to have some humility about it.
And to fit further into your picture and the point of the SPVs, you have to match up the timing of your cash flows. So if you're in a bull market and it's over your subjective valuation of what the price of Bitcoin is, and you have these big expenses coming up in a period where historically might be below your subjective valuation of Bitcoin, you would take some off to set aside to have that money where it's not cut in half, right? Um, you can stack forever, but on my side of the fence, where you're dealing with traditional wealth management, traditional portfolios, traditional monthly expenses and needs of business owners, and we have a lot of tech sales guys. Like there's cash flow mismatches on your assets, and you have to plan around that. But a value investor does, right? They just say, hey, maybe it's high, maybe it's low. If it's low, I'm going to plow in more cash flow because I'm not going to sit on the sidelines and do nothing. And if it's high, I'm going to peel some off so that it's there on the sidelines when I need it. And just stepping back, a couple of things that you mentioned, we kind of covered that there with the strategy having, an infinite time frame. I think the biggest mismatch there that personally uh, it's okay based on the stack, but they have a $300 million black hole difference between actual business revenues and dividends to be paid, right? Just based on kind of what they said they owe, I don't know,
Yeah.
600 million. And
I think
so
this is the biggest misconception about Bitcoin treasury companies as kind of, in general, right? As an economic vehicle, which is that um, if their fundamental value thesis is arbing between Bitcoin returns and cost of capital, then the cost of capital should have to be paid by selling Bitcoin
mhm,
to pay the dividend, right? And
yep,
so essentially they're converting the capital gains of Bitcoin into the dividends, but they're a smaller percentage, right? So that the value is accruing to the common stock.
yeah.
Um, and then they're looking at their MNAV and they're seeing that they're getting a signal from the market, from the equities market, that they actually should raise more common stock, bring in more dollars to buy more Bitcoin because there's interest in having exposure to this leverage vehicle
And that's
from
the securitization
on the
component.
common stock side.
Yeah,
And so if they started selling Bitcoin to pay the dividend and buying Bitcoin from issuing common stock and doing that at the same time, they're just creating a lot of friction that they could just net out
yeah,
by issuing common stock and then giving that cash to the preferreds or to the dividends or to pay the convertible note, and kind of avoid having to sell Bitcoin and all of the operational, accounting stuff
or,
in that.
or you could
So
do
it's really an
something.
efficiency argument that then people look at that outcome and they're like, oh, that's a Ponzi because you're paying old investors, with new investor money. When really it's just okay. It's a more efficient way of doing something that makes complete economic sense, which is arbing between Bitcoin returns and fiat cost of capital.
It would only be a Ponzi, in my opinion, dependent upon the size of the stack. And when you started these ATMs and when you do go into a bear, because every asset goes into a bear, nothing goes up forever. Based on the underlying business, can you stay in business, cover your cost, and not have to sell Bitcoin to do that? I would say what would make it really interesting, and I understand probably why this doesn't happen, is from a regulatory perspective. But if you're an equity holder of some Bitcoin treasury company, you get nothing, right? You get the appreciation, which you hold forever, whatever Bitcoin goes up. But where it can, to use a term that you said that I agree with, break the rules, so to speak, that those payouts, whatever instrument you own that has dividend, you could elect to receive in kind, or you could elect to receive fiat dollars, right? And that would be drastically different. Now, it would
Yeah,
push
but
on us.
again, that's just creating like additional operational friction because it's a lot easier for somebody to sell the stock on Robinhood and buy Bitcoin on Robinhood. It's literally
Well, I
in
think
the
that
same
where I'm
account. Yeah.
what I see on my side is most people, just normal people, that it's kind of like you say, hey, oh, Bitcoin's so risky, you're taking a lot of risk. It's really that they don't want to deal with the holding of it, right? So it is operational efficiencies that kind of creates friction there, but you're actually giving those holders at some point, if they did want the Bitcoin, to take it, or if they did want to just
No, but
leave it.
that's what I'm saying is that they have that ability at any time to get the Bitcoin. All they have to do is sell the stock and go buy Bitcoin, right?
Yeah, you add
It
another jump. Yeah.
and so that's where I think that there's like a lot of um uh, I think it comes down to like my product management experience at Kraken, where I always had like a view of like how it should work in an idealized sense, and then the real question is how many clicks is that on a screen, and then it
Yeah.
kind of falls apart.
That's what I was getting at, because like, okay, the inefficiency, eventually you get to where, like, okay, well, if I want the dollars, then I'll sell it and then buy it. So I'm creating a three-step process. It's quick, but I've still got to go into the app, sell one, buy the other, and then walk away. So I think from that perspective, mass adoption means you're really looking for, use a negative word here, way to re-centralize holding of it. Because just like most IT folks in the late 90s, early 2000s, most mass adoption type people don't want to set up their own network, don't want to maintain their
Yeah,
own network. Yeah.
I think this is another huge misconception because uh, if you look at, for example, when Mount Gox went under, there was a material percentage of the Bitcoin that were being held in Mount Gox. So I think even early adopters like were not great at this. So
No, no,
don't
I'm
give them too
agreeing
much
with you.
credit.
Like, there's only like 10% of the population, if that, that really wants to set up their own servers, set up cold
Yeah,
storage.
I think it's like less than 1%. And
Yeah,
then also among those, who are actually going to do it correctly, right?
correct.
Because there's I think that so there's two avenues to this. One is the products are improving, right? So I
Yes.
do think the ease of use on the hardware wallets is improving. I think
Mhm.
collaborative custody is improving. I have looked at multi-institution custody. I still am wrapping my head around,
I
what.
can't figure out fully.
Yeah. But all that to say, there's going to continue to be innovation on improving the self
Mhm.
custody side. Um, I think that the challenge for Bitcoiners is to look at a Bitcoin treasury company and to have the thought that while it's not self custody, it could financially outperform Bitcoin. And so I think that that is like the number one cause of heartache among Bitcoiners, which is that we want Adam Smith's invisible hand to align of doing the right thing, self-custodying, running your own node, and having the best financial outcome over the long term. And so with what happened with I think Trump's election was that at the margin there's lots of people who now don't think that there's a risk of the government seizing strategies Bitcoin, Coinbase's Bitcoin, like that basically property rights and rule of law are going to continue to function in the US such
Yeah.
that the marginal benefit of tail risk hedging with self custody decreased for a lot of US Bitcoiners at the margin. Not for, I mean,
Mhm.
obviously, there's still lots of great, paranoid libertarians out there who are,
But it's like,
yeah.
I used the high numbers at 10%. You use probably a realistic number one, but it's not many people. Most people just, imagine.
Well, it's a spectrum, right? So
Yeah.
there are people who would never like would never hold Bitcoin even at like River. right?
Yeah.
Like they
Yeah.
might like Alex Leishman, but they're 100% cold storage. Other people were like, well, I'm going to keep a third of my stack in cold storage, a third at a credible third party custodian, and a
Third in
third
the
in
ETF or
Bitcoin
MicroStrategy or some.
stonks,
Yeah.
right? Like miners, like the whole gamut of different speculative plays.
Well, and to hit
Um,
on that right quick before we hop off that, to hit on that,
yeah,
a year ago, I had it was an ultra high net worth guy, a lot of Bitcoin. He's like, but I'm struggling because it's in self custody. I can't borrow against it. And I was like,
yeah,
well, at some point, what is the point of having a bunch of money if you can't spend it? Right. And it's okay. So you have a number in your head from 10 years and now that you want to get to. And when Bitcoin goes on that trajectory and the CAGRs, you'll get there, but sacrificing things you want to do in life, real world today, just to meet a number doesn't make a lot of sense. And I said, look, do this. Run up a credit card, spend your and then at the end of the month, if you have fiat, pay it down. If you don't, trim off a tad bit of your Bitcoin. It's the same purpose, you know, because the friction of trying to get a Bitcoin loan and trying to get it converted or effectively giving up custody to somebody else who's going to back that loan is much the same as you know selling your MSTR and buying Bitcoin in Robinhood. Like there's always some kind of trade off or some kind of friction because it's just the way the world operates, for lack of better terms.
yeah. So I think that there's definitely the lending part, which is limited by self custody, and so there's also the options part. So there's lots of
Hmm.
people who like uh, would benefit from being able to do it in kind create on IBIT, not
Hmm.
have a taxable event, and then write option strategies around that to
Yeah.
generate income.
Yeah.
Um, and so I think that that's going to continue to they're just going to continue to create products around this, and that from a Bitcoin maxi perspective, basically what we have to wish for is for a custodian to get hacked and all these people to lose all their Bitcoin, which I think is disgusting, right? Like
Hmm.
we should not have the view that the ends justify the means of like,
Right.
well, we need to have these people suffer the consequences of trusting a third party so that they become Bitcoiners like us and only self custody.
Well,
Uh, yeah,
I think that's sort of what Elizabeth Warren and Gensler were championing because they went hardcore and threw all the notices and said, I think it was 22, 23 when FTX went down, when the regional banks crashed. They said, well, you know that the Bitcoin held on exchange is not actually your Bitcoin. You're a creditor to the exchange. And at the time, had some people call and said, well, technically your stocks are not yours. If you didn't call your custodian and say, please move my stocks out of street name into my own personal name, they technically go to DTCC at the end of the day. Like if you really went to court and tried to fight over it, not that that really happens, but legally, that's what the writing says. And I said, Warren's just trying to, because she can't kill Bitcoin with the ESG narratives, she's trying to kill it out of fear and the administration at that point. Because remember, when Biden first came in, um, or early, he issued an executive order that was pro kind of crypto and looked like they were moving that way. And then midway and once you got to the back end towards the election, they just started, chopping it off at the knees everywhere. So yeah, I think that's an interesting point in terms of it. We shouldn't be championing people to lose just to move forward.
yeah. I mean, Elizabeth Warren had a bill drafted that would have essentially banned Bitcoin in the United States. So she's ready to go the whole way. But I think what folks are realizing is that from a voter perspective, so there's like three things I think that influence politicians: votes, money, and doing what's right.
I was going to
And
say money, dollars, and cents.
Uh, no, I think that's actually a huge misconception about politics. Is that like there's lots of examples. One of campaigns that completely outspent their opponent and lost.
Hmm.
Um, and two, people spending a lot of money lobbying and not getting any results.
Yeah.
So I think that money actually has to align either with votes or with good policy, right? You got to have
I would
like
agree
two
with
of
that.
three to get something through. Um, and I think that what they realized with just broadly speaking crypto, it's bad for votes. You don't. There's no like ideological Keynesians out there who love chartalism so much that they're, the single issue voter on the dollar
Yep.
having a monopoly on currency, right? That doesn't exist. Two is that it is also bad for money because there's lots of these packs that are forming that are raising lots of money from
Hmm.
exchanges, miners, and going forward, probably Bitcoin treasury companies as well. And they're funneling money into the politicians that really have a real chance of winning. And so when you see all these three things align, you get what just happened in the U.S. Senate Banking Committee, where the Democrat actually lost his Senate seat to Bernie Moreno, who is pro blockchain, broadly
Mm.
speaking. But it is I think that that freaked a lot of people out on the left of saying, well, if you get too close to Elizabeth Warren and there's a credible challenger in your district, he's going to get votes from Bitcoin people. He's going to get money from Bitcoin people. Uh, and then
It is a
the
growing cohort.
well, yeah, and then the third question comes up of, well, who's right? Like, what is good policy here? So Elizabeth Warren, what she wanted to do, I think, is prevent the integration of Bitcoin into the financial system.
Mhm.
And I think the reason why she wants that is because at the end of the day, like you can think of it as Bitcoin integrating into the financial system. But what's really happening is the financial system integrating into Bitcoin. And I think that that is a nuance that is very lost on kind of Wall Street itself. Like they think that they're taming the
So,
beast or something. Um, but the other part of it too is that if you look internationally, this is the same thing in Europe. Like they don't want Bitcoin to be a part of the financial system because they're worried about that inversion. Where Larry Fink was talking about Bitcoin being above governments on
mhm,
national television. That chartalists don't want to hear that,
mm-mm.
and it means that it's going to be harder and harder to impose capital controls. And so when
Right.
we think about like the Bitcoin adoption thesis, one of the ways it gets slowed down is through Operation Choke Point 2.0, right? Of trying to prevent that integration. But the bigger the on ramps and off ramps are for Bitcoin in the financial system, I think that the harder it becomes for governments to control Bitcoin. So, like, um, one of these is on KYC AML. What I predict what we're going to see is that Bitcoin is going to cause the financial system to start lobbying hard against KYC AML because
What
ultimately,
was the whole premise?
yeah, it's like why are we as a financial institution subjected to requirements that
Mhm.
are unenforceable to a self-custodied wallet?
So let's step back because I think that's an important point. What I was one of the three questions I was gonna ask, and you hit on it. I would kind of disagree a little bit. I mean, I agree with the notion that the financial system will integrate into Bitcoin, but I disagree with that it's currently working that way because, and the reason why I say that is because 2 years ago, 3 years ago, all of the exchanges, at least in the US, complied with KYC AML. In some form or fashion they have. Like, you can't go to any exchange without putting your ID and verifying who you are and that sort. So that is a Bitcoin bending, or let's just call it the crypto ecosystem, right? Because it takes a system of different types to do that. But bending to Wall Street. And then,
No, I disagree. I mean, I think that that
well,
is really like Wall Street has in the past lobbied against KYC AML, and in fact, like it was litigation, right? They tried to get it to be unconstitutional by suing the government, and
but
they lost
so
under a different Supreme Court. I
yeah,
think under this new Supreme Court, it's a different set of circumstances, and then also, I mean, look, Bitcoin exchanges when they started were tiny and
yeah,
powerless, right?
yeah,
Today they're publicly traded, and so
correct.
I think you have to think about kind of the power dynamic of, okay, how important is it to not do KYC AML, right? At the margin. So, there's problems of identity theft, doxing, people getting taken hostage. Uh,
Yep.
I've seen those stories. And so I think that at the margin, there is a problem here. But empirically, we can speak about the amount of Bitcoin held at Coinbase that is KYC AML, right? And that I don't think that I don't think bringing more allies onto the side of reducing KYC AML is a bad thing. And I think it's also inevitable because otherwise they're going to continue to lose market share, specifically to Tethers, right? Where
Hmm.
Tethers has an AML KYC obligation on primary issuance of USDT, but on secondary movements on the blockchain on Tron, there's no KYC AML obligations. And
Right.
I think that's been like a key source of the regulatory arbitrage that has allowed them to grow to the size where they're at today, where I saw that they're going to try to raise like billions of dollars, at a
Yeah.
$1 trillion valuation. Um,
So that was the third question.
yeah,
So hang on, let me reframe that back because I don't disagree. Again, I'm not disagreeing, but so we've bent Bitcoin towards Wall Street KYC AML in some form or fashion. It just is what it is. I
I
do
don't
hope.
think that's true either, though, because like if we look at where are the lines drawn, right? So from a regulatory perspective, the lines are drawn about if you're converting between fiat and Bitcoin. And
Mm,
so the obligation really enters from the fact that you are doing the fiat part of the conversion, not the Bitcoin part. So, for example, if you spend Bitcoin at a store to buy goods and services, there's no KYC AML obligation on that. And
but
so
if you
to
did it
me,
through
what we're
Coinbase, there
really,
already was.
I'm sorry.
If you did it through like a wallet, a Coinbase wallet or anything like that, that your
No, I
entry
mean, like,
in.
if you're self-custodying your Bitcoin on
Yeah.
your Lightning wallet on your
Yeah,
phone,
yeah, yeah.
and you're
Yep.
paying somebody else for goods and services, there's no KYC AML obligation that attaches to that. The
If you
nature
got
of
it.
it from a FinCEN regulatory guidance perspective is really that you're interfacing with fiat. And
Yeah.
so to me, like, it's fiat bending the knee to fiat. I mean, I don't think that from a Bitcoin perspective that there's been any kind of compromise in that regard. Uh,
I'm just talking about like the exchange setup because the only way that you got that fiat on a Lightning wallet was if I went to you and said, "Hey, if you send me some Bitcoin, I'll send you $100," right? And
Or
so
you
you're.
sold goods and services for
Yeah, yeah.
Bitcoin, right? Let's
Right.
not
One way
exclude
or
the
another, but
possibility of a
yeah.
circular economy.
Right.
But it's
But
just
most are.
I'm highlighting this principle that because in the past they've also talked about I think it was Mike Hearn who proposed like integrating KYC AML into the Bitcoin protocol itself, right?
No
And
thanks.
so there's I think some really important nuances that we have to draw of understanding what is actually a compromise and what is a self-own. Because to me, it's a self-own that the whole fiat system is in this quagmire of KYC AML and
Yep.
pushes people into Bitcoin, right? And so I think that if we if we create FUD around Bitcoin, like requiring KYC AML for peer-to-peer commerce, we're
It's
gonna kind of
pointless.
muddy the waters, though.
Yeah. Yeah, and I agree on that because the point of Bitcoin is to give you optionality, but then you say, "Hey, we're gonna take your optionality," and the only way to get that optionality is to first go through a KYC AML on-ramp. You're back to fiat, and so that was kind of the question where it's kinda
You
interesting
can go to a
because.
Bitcoin meetup. There's plenty of
Yeah,
people with
yeah.
cash on them, but
But
or you
so.
start a business, right? You start an
Yeah.
online business. You set up BTC Pay server.
Yep.
I think that there's ample avenues for non KYC Bitcoin to get bought today.
So then you look at the last 2 years, you've got ETFs. They're buying Bitcoin, but those are KYC AML wrappers, that are buying it's not Bitcoin sticking ETFs inside of it. Not again, I don't think we should stick a ton of bloat on the blockchain, but, um, you got that, and then you got traditional equities, which are KYC, AML. They have to follow FINRA, FinCEN, all that. They're housing Bitcoin collateral. So those are all, again, it's not bad because it is reaching people that otherwise wouldn't go home and set up their own wallet, set up their own lightning node, set up, a lot that comes with it. So I'm kind of saying, well, hey, this is the reality of the world telling you what it's doing. And you're moving away from self custody. We covered that with the one percenters. Um, but if we let that go too
I don't think
far,
we're moving away from self custody. I think that we were already there from a self custody perspective. That most normies wanted to keep their Bitcoin at Coinbase, right? So they bought
yes, that's what I'm saying.
Bitcoin
Yeah, I
on
agree with
Coinbase.
that.
They left it there, and
Yeah,
the reason why is that the reason they bought the Bitcoin, their motivation for buying the Bitcoin was not self custody. It
just
was
number
financial
go up.
gains,
Yeah,
right?
yeah.
Um, and so I think that giving them vehicles that actually address their need better than that, right? Where, like, for example, taking a look at a leveraged Bitcoin equity, where, hey, if the only thing you care about is long term financial gain, that is the better vehicle than self custodying, right? And
Mhm.
so, but then it's if your priority is self sovereignty and holding your own keys,
You gotta own the
then
Bitcoin.
you cannot own a leveraged Bitcoin equity. And
Right.
you have to be honest with yourself that you're giving up the opportunity to have those leveraged gains. Um, and then it's just an equation, right? Of what is the expected value, right? So what's the
That's the
expect?
trade-off, and the way I say it is like, look, do you if you really think that just like gold, if you really think at some point in your financial future you need to have access to that tangible thing, then owning an ETF or owning a Bitcoin stock or whatever is not, regardless of what the return of that thing is not what you need. Now, if you're telling me I don't really care. I don't believe in that. That's all conspiracy that we might need actual Bitcoin UTXOs or gold bar or something like that in the future, then fine. You can own.
Or some combination thereof, right? You can
Yeah.
say, "Hey, I think the probability of that happening is X percentage. I think the probability of it not happening is Y percentage, and I'm going to make my investment allocation decisions based on kind of that probabilistic framework rather
Hmm.
than just it's definitely going to be Executive Order 6102 next year
Yeah.
versus not." And so I think that the other thing we're going to start seeing is what does it look like when Bitcoin treasury companies actually do custody their own Bitcoin
Right.
or use custodians that are multi-jurisdiction.
Hmm.
Because then at that scale, I think that you start to really narrow down the probability of kind of political interference with these companies.
Yeah.
And I could actually envision a future where, um, people have accused like Mark Zuckerberg of running Facebook like, it's a government. And in a way, it is. It's like this kind of
Yeah. I
sovereign,
mean, yeah,
quasi
they've
sovereign entity. And
distorted a lot of the population in one way or another. I mean, so they do have a powerful control mechanism.
I think the same is going to be for the Bitcoin treasury companies.
Yeah.
And so they're going to be quasi sovereigns under a completely different, fact pattern than any of the other, whether it's ETFs or the exchanges or the other participants in the ecosystem, even the
Yeah.
Bitcoin miners, right?
So,
Although some of the Bitcoin miners are treasury companies themselves as well.
so that gets to that third question, and now I'll throw a little piece on the end, but back to stable coins. So let's just look at Tether, for instance. It owns, uh, treasuries, a ton of gold, a ton of Bitcoin. They have AI and mining infrastructure, Bitcoin mining infrastructure. So they have all these layers, right? And so if you said, wow, if I could have money today that was not just backed by one thing, confidence, um, military power or whatever, it kind of has a lot of that in it. And then they've issued now onshore, offshore dollars. So effectively kind of created that true euro dollar type instrument, but has Bitcoin capability in there as a component of that. Um, do they become issuers? So that's the one piece. Then the other piece, to your last point, you kind of see that political nature, that like how a political system shifts when Facebook start to have control and power more as much as governments, or they're doing it for governments or whatnot. Um, you see that kind of poured it onto, let's just use Tether for this example because it's probably the one that has the most diverse backing. Um, do they then package that up and issue it into a Bitbond like instrument with different slivers of those things like a CMBS and MBS? Or does that just they do kind of the currency part and hold the collateral assets, and then somebody like a Bitcoin company like yours just does the Bitcoin sliver piece of it? Have you thought through that, or does that even make sense?
I think that what will end up happening, for the most part, is that Tether is going to accelerate the dollarization of foreign countries, and
Hmm.
so I think that's where the demand for holding tethers is mostly going to come from. Is that process? Um, I'd be surprised if I just think the U.S. market is very competitive
Hmm.
from kind of a fintech payments perspective. Where, um, yeah, I'm sure there's people who don't have access to a bank account in the U.S., and so stablecoin like makes a lot of sense for them. There's some people who would benefit from the regulatory arbitrage on KYC ML, but I really don't think that it's like we already have dollar privilege here, so like we
Right.
already have
It's not
dollar
a problem
denominated
for
credit
us.
cards. Yeah.
Like if we need dollars, there's 50 ways to get them. But
Yeah.
if you're, one of the other, seven and a half, a little more than
But
seven
yeah,
and a
I
half.
think Tether's going to continue to grow at a rapid pace, and they're going to do really well for themselves.
Yeah. So yeah, if you're one of those other people, then you'll use a tether on something else. But does that, in your mind, does that help kind of a Bitcoin bond get adopted, or
I,
is that
I
just
I think it's
some?
pretty orthogonal. I mean, I don't think there's any intersection over that. But what I do think it's going to help is really increases Bitcoin's liquidity, right? Because it's so easy to flip between Bitcoin and tethers that ultimately that's good for Bitcoin is kind of making sure that pair is as liquid as possible.
Yeah, and then eventually that makes that earlier part of the conversation, like switching between Bitcoin and dollars, much easier because those dollars technically are on new financial rails. So, and it wouldn't matter what political jurisdiction you're in if they have a U.S. tether and an international tether that can work on Tron or whatever else it may be.
That's right.
So, well, Pierre, I appreciate your time today. Enjoyed the conversation. Maybe you can tell listeners where they can go back and read more of your work and follow along with you.
Yes, so nakamotoinstitute.org, and you can follow me at Bitcoin Pierre.
Awesome.
All right, thanks. Again.
Na na